Big couple of days coming up. Live from New York City this morning. Good morning, good morning. Equities just about holding on here, trying to bounce on the S&P by 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, markets on edge ahead of key results from Nvidia. Retailers sounding the alarm on the consumer as the GOP prepares for a high-stakes debate without Donald Trump. We begin with the big issue, resilience or complacency.
The economy remains very resilient.
Data just continues to be very, very resilient.
Growth so resilient.
Equity markets remain quite resilient.
The U.S. consumer still remains extremely resilient.
It certainly looks as if third quarter is going to stay pretty resilient.
The economy appears to be on solid footing.
All this talk about a recession so far hasn't panned out.
I think we've gotten too optimistic on the growth front.
There is some complacency.
Market complacency.
People being very complacent.
That usually leads to some sort of natural pullback.
It's really hard to see material upside to equities.
Over time, higher for longer should slow things down.
We still have this mild recession in the forecast.
We are going to have a recession at some point.
At some point, you're going to start to see things break.
At some point. Morgan Stanley's Jim Karen joining us now alongside JP Morgan's David Leibovitz. David, is it complacency or resilience?
So I think it started as resilience, but it does feel like it's beginning to morph into complacency. I think, you know, taking a step back and thinking about why the economy, the U.S. economy in particular, has been so strong this year, so much stronger than people expected, it really has to do with the state of the consumer and the state of the labor market. But, you know, we recognize the lag impact of shifts in Fed policy. We recognize that 12 months ago, you know, the Fed funds rate was still down in the twos, and we think that, you know, a lot of these rate hikes that we saw into the end of last year are going to start to bite. And unfortunately, I think that this is coming at a time where markets are increasingly warming up to the idea that we could have a soft landing next year. I'll call it complacency. Your colleague in the investment bank agrees. Marko Kolanovic saying this: compared to the start of the year, investor expectations, market positioning, equity valuations have moved up. Marko goes on to say, with soft no landing the new base case, there is no more fear, only complacency. Jim Karen, which camp are you in?
I'd like to pick that apart a little bit and say that, look, the labor market has been very, very resilient. I think the growth sector, let's say like within equities, which is what's driving most of the indices higher, maybe that sector of the market has become a little bit complacent and dependent on those increases. So, you know, I think it's a good mix of the two. I think people are pretty worried. I mean, when you ask people what they think about the future in terms of recession expectations, they have them. They have the Fed cutting interest rates at some point in the first half of next year. They're only going to do that if we see a slow.
Bit of a technical problem there with Jim Karen over at Morgan Stanley. David Leibovitz, I'm pleased to say, is still with us. We'll reconnect with Jim in just a moment. David, just to build on some of the things we're thinking about here, I think Jim did a decent job at the start of those comments. Draw a distinction here between what's happening with the economy and what's happening with the market. You were talking about the market. Let's talk about the economy. Mortgage rates running close to 8%, 7.5%. Mortgage applications this morning, the lowest since 1995. Now, I would say, David, unsurprising. The question we've got to ask is just how rate sensitive is this economy? Are we finding out it's far less rate sensitive than we thought it was?
So we are finding out that this is a less interest rate sensitive economy than a lot of people originally thought. And, you know, primarily this stems from the behavior that we saw not only in the immediate aftermath of COVID, but really over the better part of the expansion post 2008, where consumers delevered, they termed out their debts, right? They took advantage of very low interest rates to extend the maturity of the loans that they were taking on. And overall, we have seen this create a less interest rate sensitive consumer, but we're also seeing it on the business side as well, where normally you would expect a big increase in rates to have an impact on interest expense. We're just not seeing it because, again, businesses have been successfully able to term out their debt, particularly over the course of the past couple of years. But you look at where mortgage rates are today. Importantly, you look at other parts of the world, namely Europe and China. Europe in particular, the manufacturing sector does look like it's coming under a bit of pressure here. And I do ask myself if this story of resilience in the U.S. economy is really dependent on the continued resilience and health health of the consumer, you're seeing kind of the cyclical parts of the economy globally begin to crack, and I think it's just a matter of time before that shows up here in the United States.
Yeah, David, to build on that, China right now not great at all. The PMIs out of Europe just absolutely dreadful this morning. Germany, across the Eurozone, the UK as well. I'm pleased we've reconnected with Jim Caron because, Jim, I'd love for you to speak to this. The US economy, in the rest of the world, it looks like services is coming down to manufacturing. In the US, Jim, do you think manufacturing can come up to services?
Well, that's our core thesis. I do think it's more manufacturing coming up to services. Now, look, the base case that I have is that we're still going to have a soft landing. That still means we likely have a mild recession, but it's a mild recession. So I think the service sector, which has been strong, and I think certainly the manufacturing sector has gone into probably more of a recessionary type of a level. But as we see this resilience, I think in the labor market, I think that what you're going to see is more investment, more CapEx, and I think there's going to be probably more support for a softer landing. So I take the opposite view on this than probably most do. I think it's manufacturing going up to services.
25 minutes away from the opening bell. Equity futures right now on the S&P 500, just about positive by 0.1%. Into the bond market, we've gone through some big levels in this bond market in the last couple of days, the past week. The 2-year still really close to 5% at 499.25. We're down 5 basis points on a session today. The 10-year, after going through 430 and making a new cycle high in the last 24 hours, we're back down by 6 basis points to 426.67. Jackson Hole, the annual Fed get-together, kicks off tomorrow. Chairman Powell speaks on Friday, 10:05 Eastern Time. On the ground, Mike McKee joined us from Wyoming for a preview. Good morning, Mike.
Good morning, John. Well, you just mentioned the bond market. One of the big questions is, why are yields so high at this point? Bond market participants say there are a lot of different reasons, but how much of it is due to the Fed? That'll be one of the discussions here at Jackson Hole, along with what happens next. It's a question about structural changes in the U.S. economy. That's the title of this meeting. And do we see things change from the way they were before the pandemic permanently? Go back to maybe where we were in the 1990s in terms of yields. So a lot for them to discuss here. Jay Powell, as you mentioned, kicking it off on Friday morning with what is titled an economic outlook. Is he going to talk more about rates and where they're going? Maybe he will say the same thing he said before, that we're going to continue keeping rates high until inflation comes down. They have made a lot of progress since last year. Inflation way down from when we were here a year ago. Unemployment hasn't gone anywhere, still very low. Nobody really quite knows why. So a lot to discuss, and everybody's going to be looking forward to Jay Powell's speech and how much of a hint he gives Wall Street about what actually is going to come next.
Mike McKee, right now, just looking at you, I'm more impressed by this outfit than I am the backdrop. Mike McKee makes me want to go home and repack and get some new clothes for this trip. Mike, good to see you. Looking forward to catching up over the next couple of days. Mike McKee on the ground at Jackson Hole, Wyoming. Just absolutely stunning over there. Equity futures right now on the S&P just about positive going into Friday. And Chairman Powell, David Leibovitz, what are you looking for from the Fed chairman on Friday?
So I don't think we should be looking for any big surprises. My sense is that Powell is going to get up there and he's going to reiterate exactly what he's been saying over the better part of the past couple of months, which is we've come a long way. We've made a lot of progress. We're not 100% sure that the inflation issue has been completely put back in the proverbial bottle, and so investors should expect interest rates to remain higher for longer. I think we're seeing markets reprice here and reprice more in line with what the Fed has been telling us, but there are still cuts in market pricing for 2024, and the only way that we get there, in my view, is if we see a more significant deterioration in the overall state of economic activity. And so I think what Powell's going to try to do is lift those futures dots and try to bring them more in line with what the Fed themselves are forecasting, but really reiterating that message of higher for longer being the base case view down at the Fed.
Just to add to that, Jim, how far along do you think we are in that adjustment process to that higher for longer reality in the bond market specifically?
Well, look, I mean, I think the bond market's pricing it pretty well. I mean, higher for longer makes a lot of sense right now. There may be one more rate hike on the cards. Now, look, I think that Jackson Hole is going to be an opportunity for Powell to flip the narrative a little bit. What Powell and the Fed worried about was growth, and they were concerned about inflation. Today, I think they're going to really focus on inflation and have some concerns on growth. And the reason is that the labor market has proved to be very, very resilient. And now They believe that growth can be sustained, but now they absolutely have to get inflation down. So the veiled message I think that comes out of this was with Powell talking about higher for longer and talking tough on inflation. Essentially, what he's going to likely do is steer us towards a mild recession. And for me, for one, the way that I would think about this, a mild recession that comes sooner is better than a recession that comes later, because a recession that comes sooner is likely mild. A recession that comes later is probably a harder landing. So I think Powell wants to get this over with quickly, get inflation back towards target levels, talk a little bit tougher, talk about higher for longer. And I think the veiled message is going to be probably towards a recession, although they're not going to explicitly say that, of course.
So, Jim, make it easy for me. Is that a buy for the 10-year or not?
So I think it's a modest buy. I think that these levels in yields can probably hold in reasonably well. I'm more concerned about the shape of the yield curve. Look, if the Fed cuts interest rates 100 basis points or 150 basis points, from current levels at some point in 2024, what's the shape of the curve? If the curve goes to zero, if let's say 2s, 10s goes to zero, that keeps the 10-year note still around 4%, right? So, or 4 to 4.25. So I don't see a lot of downside in yield here unless we bake into the cake a hard landing.
David Leibovitz, final word.
So I wouldn't disagree with that. I think the one thing I would add is that we need to respect the technicals here. And if you look at what some of the charts are saying, it does suggest that there may be some further upside for 10-year yields relative to current levels. But, when we look at the broader investment opportunity set today, we do think that high-quality fixed income looks attractive. You are finally getting paid something that's positive on an inflation-adjusted basis. If this is the high watermark, your guess is as good as mine. But more interested at these levels than we have been in some time.
David, Jim, stick with us. Equities right now just about positive on the S&P by 0.2%. A ton of movers out there ahead of the opening bell. Here's Abby with more. Hey, Abby.
Hey, John. And there's certainly some big movers in the retail space and to both sides. As you know, Foot Locker absolutely plunging. This is the worst day, I believe, in at least a decade. I was trying to go through the calculations by hand, and actually Netflix is up 1.7%. And as a Netflix subscriber, I'm very happy to have learned that they will be allowing us to keep the discs once they stop sending out the discs at the end of September, but also subscriber numbers on track. Now, Nike, one of those retail movers that I was talking about, Foot Locker absolutely plunging, as we were talking about, and that is, of course, on their slashed outlook, cutting the dividend, the stock plunging down more than 30%. Nike, 65% of their revenue going back to last year, their merchandise. So Nike falling in sympathy. And then Advanced Analog Devices, their outlook is disappointing. You can see that stock down about 4.8% more on retail in just a little bit, John.
Abby, thank you. We'll catch up with you around the opening bell. Coming up, retailers under pressure.
Biases in terms of consumers moving more toward generic type brands as opposed to higher end brands. If we start to see more cracks in the labor market, I think the consumer could maybe shut down the spigots fairly quickly.
Foot Locker getting absolutely hammered. That conversation up next.
There's definitely some dichotomies going on, and I do think that part of it has to do with what consumers are prioritizing. They're continuing to prioritizing services, they're continuing prioritizing food and drinking places, and they're not so much prioritizing retail and furnishings. And I think that's part of what we're seeing in some of those retail earnings. That's really the undertone.
More pain coming to the retail sector. Foot Locker cutting its outlook and suspending its dividend, becoming the latest victim of a slowing consumer. The CEO saying we did see softening trends in July and are adjusting our outlook to best compete for price-sensitive consumers. It's the latest red flag from US retailers as Nike sees a record run of losses. Sales are dropping over at Macy's. Dick's Sporting Goods is warning about theft as Target and Walmart have their eye on student loan repayments. Walmart CEO saying this in the past week, resuming student loan repayments, higher borrowing costs, tightening lending standards mean household budgets are still under pressure. Katie Greifeld has the story. Hey, Katie.
Hey, John. Well, we heard it loud and clear from Macy's yesterday. We heard it again from Foot Locker this morning that resilient U.S. consumer maybe starting to pull back here. Foot Locker shares off an incredible 32% pre-market on the heels of that forecast cut, and that's sending a chill through its supply chain as well. You take a look at Nike, you take a look at Under Armour, both under pressure this morning. They're both suppliers to Foot Locker. Nike, in particular, on track for a 10th straight day of losses, given that Nike, 65% of athletic merchandise was purchased from Nike by Foot Locker in 2022. Now, this Foot Locker report, it comes a day after that Dick's Sporting Goods report that you talked about just earlier. A similarly disappointing report and forecast there. It also cut its profit outlook for the year, and it also cited increased theft at its stores. We know that shrink is a problem for these retailers. But if you're looking for a bright spot, John, you will find it in Abercrombie & Fitch, actually boosting its profit outlook. Its Hollister brand returning to net sales. Urban Outfitters, too, also beat on earnings. John, my takeaway there is that teenagers are still buying clothes.
There we go. That's good to know. Katie, thanks for the update. Katie, thank you very much. It's mixed out there for retail. The negative headlines, though, they seem to be the dominant headlines, as always. Jim Kerr and David Leibovitz back with us. David, there are reasons to worry. Are there reasons to worry a lot from your perspective, looking at some of those names that Katie just went through?
So I think the important thing to recognize is that, the consumer is 70% of U.S. GDP. So what happens with the consumer is very much going to dictate what happens with the economy at large. We are seeing signs that consumers are coming under pressure. You can look at the savings rate, which is well below its long-run average, the increase in credit card use. If you look at kind of excess savings, right, according to the Federal Reserve, they believe that it was exhausted in the U.S. Over the course of the summer. And so I think you're beginning to see the consumer bend more so than break, but obviously that does suggest tougher times ahead for the overall U.S. economy.
Here's the constructive way of looking at it. Mark Zandi, Moody's, he says this: income growth is now stronger than inflation. The need for excess savings to support continued sturdy consumer spending is thus fading. Jim, would you take that favourable view of things going forward from here?
No, I'm a little bit more skeptical and a bit more cautious on this. Look, the way that I see this is I see the consumer is starting to weaken. But look, the reality is that interest rates are rising. This is what's supposed to happen. This is how you cool down inflation. So this is all part of the overall plan. Where I start to get a little bit more concerned then is, what do these companies do in terms of trying to address profit margins? So what they were able to do before, because people had a lot of money coming in and savings, is every time inflation went up, they just raised prices and they kept their margins the exact same. Today, now they're not going to be able to do that, so they're going to have to cut prices in order to get the same amount of volume moving through their stores. So the reality is that you end up getting a narrowing of profit margins, which could also hurt earnings growth. And then that probably leads to some of the wobbliness that's in equity markets today. Now, I don't think this is the end of the bull market or anything like that for equities at all, but I do think that we could see an additional adjustment lower as the markets start to really internalize what it means to have a soft landing in a mild recession. If we have that, which I think will come up at some point in the future, maybe in 2024, possibly, the reality is that there has to be some price adjustment in these assets. And I think that's happening, but I think it's a correction. I think it's an adjustment. And again, the sooner we get this over with, the better off we're going to be.
Well, let's pick out a part of the market, specific part of the market. David, let's talk about consumer discretionary. Huge outperformance this year in places like airlines, elsewhere for the cruise operators as well. We've seen big gains through 2023. And David, you know the story. We brought forward all that goods demand in the pandemic. We pushed out all that services demand, and we're working our way through it now. Working our way through that excess savings, working our way through all of that pent-up services demand, to go on vacation, to fly, to go on cruises, whatever. David, are we at that point now where you think we should fade that story in the equity market?
So I do think that it is becoming the time where we want to fade that story. And I recognize the point that you made about, real income growth being positive as inflation has started to come down. But I tend to think that the impact of that overall dynamic on profit margins is really the one to watch. And I think we talked about this a couple of weeks ago. If you're a business that's trying to defend their margin, you basically can do three things. You can pass along higher costs in the form of higher prices. You can reduce your investment spending, or you can reduce your employment. employment. And, to the point that was made earlier, right, that ability to increase prices, it's fading. Inflation is coming back down to earth, and that pricing power is finally running its course. That means that businesses are going to have to make a tough decision. Do they pull back on investment spending if there is some to cut, or do they have to pull back on employment? I think we're increasingly getting to the point where you're going to see businesses pull back on employment, and that obviously undermines a lot of the strength that we've seen in the consumer over the past 12 to 18 months.
So, David, you've explained what you don't like then. Tell me what you do like in the equity market right now. What are you advocating for?
So we'd be focused on hitting singles and doubles. To me, this is not a market for heroes. We like the lower beta dividend-paying stocks, consumer staples, utilities, so on and so forth. We would be inclined to add to growth names if we saw valuations re-rate, but given where a lot of those companies are trading today, we just don't love the entry point from a valuation perspective. So kind of straddling the line between value and growth, leaning a bit more into value today, but definitely dipping our toes in growth when valuation presents us with that opportunity.
Jim, I've got a minute on the clock. Final word, please.
So look, I mean, I agree with a lot of what David's saying, and what I'll say is materials and industrials are areas that we're also looking at as well. We do think that the U.S. is in a manufacturing renaissance. It's trading a little less with China now, trading more, with Mexico and other places, Canada as well. So I do think that the materials and industrial sector, once we get a broadening of the breadth of the rally to start to come through, I think those are going to be good, very good places to be. Growth, we still like it, but it's name specific and it's going to be valuation specific. Fixed income, look, we still like higher yielding assets in the markets. We don't think we're going to go through a large default cycle, although there will be some stress near term, but we see this largely as a buying opportunity.
Neat and tidy within 60 seconds. Jim, thank you. Jim Caron alongside David Leibovitz. To the both of you, thank you. Equity futures right now just about positive on the S&P 500. Coming up, the morning calls and later. UBS's Nadia Lovell steering clear of big tech stocks ahead of earnings from Nvidia. That conversation still ahead. Equities doing okay here, about 5 minutes out from the opening bell. Just a little lift going into a big earnings report later on this afternoon. That's the price action. Here are some morning calls for you. First up, Edward Jones upgrading Dollar General to buy, expecting growth to re-accelerate due to improving fundamentals and weakening competition. Your second call from Morgan Stanley upgrading Brown-Forman to overweight from underweight, raising shares by 2 notches as margin headwinds turn into tailwinds. And finally, Wedbush downgrading Dick's Sporting Goods to neutral, seeing a challenging outlook as consumers cut spending on leisurely sporting items. I think that's something about barn doors and horses bolting, and I think you know what I mean by that. The stock is down by 2.8% after cratering in yesterday's session. Coming up, the best performing stock of the year reporting after the closing bell. Nadia Lovell of UBS on why she's steering clear of big tech. We've hit a rough patch in this equity market, down for 5 days out of 6 on the S&P, trying to bounce. Elevated this morning by just 0.25% on the S&P 500. On the Nasdaq, up by 1/3 of 1%. 2 big events. One on Friday, Chairman Powell. The second one a little bit later, Nvidia. After the close. There's your opening bell. Switch on the board and get to the bond market. Yields look like this on a 10-year. A rally for once. How refreshing in the Treasury market. Yields are lower by 8 basis points to 4.2469. The euro weaker. I've said this a million times. I know I'm on repeat. The data out of Europe, dreadful. 108.28, the euro negative by 0.2%. Crude lower as well. A break is 78 on WTI. 77.96. We're negative there by about 2%. 20 seconds into the session, here's the state of play for you on the S&P 500, up by 0.25% on the S&P. The Nasdaq with a similar move. Nothing like that on Foot Locker. That's the stock to watch at the open. Shares getting absolutely hammered after the retailer cut its outlook and suspended its dividend on weakening spending patterns. The CEO saying this: we did see a softening in trends in July and are adjusting our outlook to allow us to best compete for price-sensitive consumers. Abby has more. Hey, Abby.
Hey, John. And on this, we are having a record softening pattern on the stock. It is having its worst day on record going all the way back to July of 1980. And what makes this amazing, this stock into this report already down 39% on the year. There's a 21% short interest. So this weakness not taking everybody by surprise. But even with that expectation, we still have the stock down so much. They've absolutely slashed the earnings guidance by as much as 35% for the year. As you know, they suspended the dividend. There is that 11% short interest. So these trends that they're talking about, that they're seeing, they're really moving into the numbers, the financials, investors slashing the stock as a result. But it's not just Foot Locker, and this is a real story of the haves and have-nots, because we have Abercrombie and Fitch. They boosted their full-year view. The namesake brand was strong. The teen brand Hollister also strong. Kohl's going in the opposite direction, not just from Foot Locker, but Macy's also. They put up 125% earnings beat. Their inventories are improving. They're clearing out the merchandise, optimized assortment, all positive. And then Urban Outfitters, another strong one, a 24% earnings beat, 1.8% sales beat. The discounts are fading, and apparently their customers are choosing fashion over price. So on the year, it stands out that Abercrombie and Fitch, or excuse me, Foot Locker is the stock that's down into today, down 39%, whereas Abercrombie and Fitch up 80%, Urban up 43%. Again, a story of the haves versus the have-nots.
Abby, thank you very much. Foot Locker does not have a lot right now. It's negative 34% in early trading. Nike, 10-day losing streak over that period, down more than 11%. That is a record losing streak for Nike right now. That stock is negative on the session by 4%. Let's stick with earnings. Toll Brothers topping Q3 profit estimates on increasing home deliveries and surging unit prices. The CEO saying this: while rising rates remain a challenge, they further cement the lock-in effect that's kept resale inventory at historically low levels. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, Toll Brothers up more than 2% after delivering that beat and raise quarter. Third quarter EPS, revenue, and total home sales all beat estimates. And the look ahead is similarly rosy. If you take a look, the luxury home builder sees year-ahead deliveries between 9,500 and 9,600. The lower end of that range was previously the upper end of their forecast, so raising that. And Toll Brothers also boosted its gross margin forecast. That is boosting the stock this morning. As the CEO said, this extremely tight housing market, it's been good news for the home builders in general, and particularly for Toll Brothers. Resale inventories are historically low due to very high rates, but also due to the fact that we're coming out of a decade of underproduction of homes. That dynamic, of course, has been a tailwind for shares all years. You take a look at Toll Brothers up more than 50% in 2023, John.
Nobody's selling their house. Nobody's going to anytime soon. Katie, thank you. Toll Brothers up by close to 2%, as Katie mentioned. Let's stick with that name. Just a word from the South Side. Raymond James seeing plenty to like from the earnings report, writing this today. With its rapidly improving operating efficiency and best-in-class land positions, we believe Toll Brothers warrants a tactical move to the analyst favourites list to take advantage of the recent pullback among builders due to rising interest rate fears. That stock is up by close to 1%, just fading just a touch. Peloton. The tough year gets even tougher. The company issuing a disappointing forecast due to weakening subscriber trends. The CEO saying, quote, the slowdown exceeded our expectations as consumer spending shifted towards travel and experiences. Simone Foxman has the story. Hey, Simone.
Hey, John. Yeah, analysts hoping for commentary about the company's transformation, sweetened, as a Bernstein analyst put it before the results, by a nice surge of new app users. Instead, they got that negative commentary on subscribers, in addition to more trouble on its hardware business. A recall of about 2.2 million seat posts, costing more than $40 million than it had anticipated. And in addition to that, 15 to 20,000 subscribers choosing to pause their subscriptions until they got those new seat posts. They've received about 750,000 requests for that seat post replacement. The dented that first quarter forecast, that's the next quarter, they think they're going to see a loss of $10 to $20 million. Analysts were anticipating a profit. Perhaps the only positive things there was that their fiscal fourth quarter was roughly in line with expectations, and subscribers were up on a 3.8% year on year. But in a shareholder letter, the CEO writing to stockholders, I'm signaling significant potential upside, but considerable uncertainty, John.
Simone, thank you. That stock is down by 21%. The two big events of this week, you know them well. Chairman Powell on Friday in Jackson Hole, Wyoming. After the ballot a little bit later, earnings from NVIDIA. The equity market darling of 2023, the vehicle to chase AI hopes and frenzied dreams, following a more than 200% gain for the year so far and a blowout quarterly report last time around. Just how high is the bar going into today's results? Ed Ludlow has more. Hey, Ed.
Good morning, Jonathan. Sky high. I mean, NVIDIA earnings on the same plane as Fed Chair Powell at Jackson Hole. I like that. In all seriousness, the story is, does the AI momentum that NVIDIA has seen in 2023 have staying power? The expectation is 65% top-line growth for $11 billion of revenue in the fiscal second quarter of fiscal year 2024. It was interesting. Citigroup had a note out that for institutional investors and clients, their expectations are even higher, $12 billion of revenue. Either way, the average analyst estimate and that 12 billion institutional figure is above what NVIDIA guided last quarter. The staying power story, we go to the full year fiscal 24 guidance for revenue. The estimate for that is $43.98 billion. There are those out there in the market who want to see some revision higher on that in terms of the guidance that NVIDIA gives. In the quarter that they report, the fiscal second quarter margins on an adjusted basis, 70.1%. We might get some evidence that margins continue to creep higher throughout the year. If there's a concern, it's on the supply side. Was NVIDIA able to get the chips that it needed from its contract manufacturer, TSMC? Of that $11 billion of sales, $8 billion is around $8 billion is for data center, and that really feeds into the AI story, those higher margin chips. We're talking H100. We also want signs of demand for the next gen chips, the GH200, for example, that NVIDIA announced earlier this month. The market is waiting for this one, John. I think the options market's pricing in an almost 10% swing. This is a stock that is almost 4% of the S&P 500 on a weighting basis. I'm incredibly excited. Look forward to it.
It's the story of the year in the equity market for sure. Ed, thank you. The stock of the year. No dispute about that on the S&P 500, given its performance so far. And for some of you, I know, it's the story of the week. Much more so, perhaps, than Chairman Powell on Friday. We'll see about that. Nadia Lovell of UBS expected a shift in leadership within the equity market, seeing upside in beaten down energy stocks and keeping big tech on her list of least preferred sectors, along with real estate and utilities. Nadia Lovell joins us now for more. Hey, Nadia, let's start with tech. Why steer clear of some of those big names?
You know, as we know, it's been a well-loved sector and valuation is quite elevated. I mean, our view is a lot more nuanced. I mean, we've seen tech take a little bit of a breather since July, down about 7% since mid-July. You know, the earnings reports were quite mixed. Of course, we continue to see weakness in PCs and smartphones, and that did have impact on some of the semiconductors and hardware companies. The IT budget environment is still quite tepid. You know, but that said, I mean, the AI theme we think is strong and here to stay. And so that's why I say there's nuances in our view. When we sort of look out on the horizon, we do think that demand, AI demand is broadening. We heard that throughout the earnings season. CapEx related to AI is increasing. And our expectations for the end market demand for AI over the next 5 years, we think is going to be a 60% CAGR. But that said, Jonathan, you want to remain selective at this stage and really be valuation sensitive and really focus on those companies that have, you know, distinct monetization opportunities and developments.
Well, Nadia, elsewhere, as you know, massive multiple expansion through the year so far. A huge adjustment in the yield curve too, more recently, much more so over the last month. Do you think there's some tension there that needs to be resolved between what we've seen develop in bonds more recently, in rates, and what we've seen in multiples all year?
Absolutely. That's been one of our points, that we think that valuations are quite elevated. Yes, they have come in a bit in the last few weeks, but they're still elevated in the context of higher rates. I mean, that said, in terms of the pickup that you've seen in bond yields, this is partly why we have a slight preference of bonds over equities, just given valuations. But we do expect bond yields to come back in. We know that some of this has been driven by technical as well as fundamental factors. So huge expectations of supply coming to the bond market to fund looming government deficit. But when we look into the end of the year, we think that the economy will slow down, inflation will abate, and as we look forward into 2024 and the possibility of rate cuts, we do think that yields will come back in. And so we're looking for the 10-year to be in the range of 3.5 to 3.75 by the time we get to the end of the year.
Nadia, as you know, at the moment, growth is above trend. You believe in sub-trend growth by year-end. Nadia, can you identify maybe some subtle signs that slowdown in this economy is starting to build?
Mm-hmm. Absolutely. I mean, look at some of the retailer earnings, right? We know that the Atlanta GDP now is trending at 5.8% for this quarter. We think that that's going to come down, but we are expecting near term, Jonathan, at least for the third quarter, above trend economic growth. But when we look into the end of the year and into next year, we're looking for more GDP sort of be sub-trend, probably in the 1% range. I mean, there are cracks of the consumer. Yes, the consumer remains strong overall, but there are pockets of weakness, whether you look at delinquency rates going up, and whether it's in autos or on the credit cards for some of these retail companies, we're seeing that. And so we do expect consumer spending to start to slow as consumers' excess savings dwindle.
So, Nadia, one thing that stands out, and you and I have talked about this before, and you can help me explain it, you maintain a Brent target of 90 year-end, even though you expect growth to go from above trend to sub-trend, and you also like energy stocks. Just reconcile those things for us.
Well, Jonathan, we have actually updated our Brent target to $95 by year end, and we expect that to continue into 2024. I mean, when we think about energy, of course, the demand side still looks very strong. Record level demands probably this month. And even when you're seeing weaker economic data, activity data, and industrial data from China, reality is the mobility data is still quite strong. And so oil demand has remained strong for China. When we look at some of the data around waterborne crude oil, it's actually imports are actually looking to be record levels. And then, of course, on the supply side, we have OPEC Plus that has been production cuts are has pushed production down to a near two-year low. And we know that those production cuts for Saudi Arabia and Russia extends into September. And so we think that all of this is going to support high oil prices. We're looking for a deficit of 1.5 to 2 million barrels a day through September. And so we continue to favor the energy sector as a result of this. Also, oil, long-dated contracts, the markets right now is in backwardation. And we've also been advising clients to really use volatility strategies and sell downside to oil as well.
Are clients giving that trade any love, Nadia? Given that you're telling them slow down in China, slow down in Europe, slow down in the US, buy crude?
Yeah, well, you know, the recent prices that we've seen through this summer helps to encourage clients to leg into that trade.
Nadia Lovell, the update over at UBS. Nadia, always enjoy the exchange. Thank you for joining us as always. About 13 minutes into the session. This is what we look like at the moment. Going into NVIDIA later on this afternoon. We're positive by 1/3 of 1% on the S&P. On the Nasdaq, we're up by 0.4%. Coming up, the GOP squaring off in Milwaukee.
This is going to have to be their breakout moment. Americans are looking for people who are going to solve problems, who will address some of the issues that we're facing. And they're not looking for somebody that just can be the nastiest on stage.
8 GOP hopefuls looking to stand out on stage. Team coverage up next. Downside surprise, the dividing line between expansion and contraction on a PMI, 50. Sub 50 on manufacturing, 47. The estimate, 49. On services, 51. The estimate, 52.2. This is a preliminary reading for the month of August. 50.4 on the composite. The estimate, 51.5. Off the back of that data, big bid comes into the bond market, a rally. Yields are lower by almost 11 basis points at the front end. We've seen some big moves in the other direction more recently. The 2-year now, 4.94. The 10-year down 11 basis points to about 4.21 after hitting a cycle high well through 4.30 earlier on this week. Off the back of that, yields lower, dollar weaker. The euro. Bear in mind, earlier this morning, the data out of Europe was, to use a word I've used all morning, dreadful. The euro was much weaker. The euro at the low of the session, 108.03. We now fill the gap, almost unchanged on the session at 108.43. So the dollar weakness kicks in on the other side now off the back of weaker than expected economic data out of the United States. Weaker data, will that be a focus for the debates a little bit later? It's round one of what's set to be a brutal fight going into 2024. GOP presidential hopefuls squaring off in Milwaukee, Wisconsin. And who won't be there is perhaps just as, if not more important, than who will be.
Donald Trump.
President Trump.
President Trump.
President Trump asked me to put him over the Constitution, but I chose the Constitution.
They care deeply about Obamacare. And Donald Trump promised him he'd repeal and replace it. He had a Republican Congress. He didn't do it.
It really does take 2 terms as president to be able to finish this job.
He would need 110 years as president to be able to finish the wall. He didn't get it done.
His policies during the 4 years he was in office were very positive for North Dakota.
It would be a lot easier for me as a Republican candidate in this race if Donald Trump were not in it.
The former president with a commanding lead in the polls, the latest from CBS YouGov, leaving his closest challengers well behind and looking to close a widening gap. Your team coverage starts right now with Bloomberg's Anne-Marie and Katie Lyons down in Washington, D.C. AMH, what are you looking for a little bit later?
Well, Jonathan, there's a few developments over the past hour that is really going to highlight this evening's debate. One, we do know that the former president, there's been lots of reporting about him sitting down with Tucker Carlson. Well, actually, the former president took to Truth Social and said sparks will fly tonight. They're going to air that interview on Twitter at 9 p.m., so exactly when the debate starts. So this is Trump really just owning into his base and shrugging off the RNC. When it comes to the actual debate stage, another development is that Doug Burgum, the North Dakota governor, who you saw there speaking on balance of power as well, will potentially not be in attendance. He was playing a pickup game of basketball this morning, hurt himself, went to the emergency room in Milwaukee, and it remains to be seen whether or not he's actually going to make that stage. Then we're definitely down to 7. And one thing to focus on, center stage physically, will be Ron DeSantis, given the fact that of these individuals that are on the debate stage, he is leading in the polls, but also he's going to be center of those attacks. He needs to try to hold himself in that second place. And then, Jonathan, potentially there's an opening for someone else.
Kelly, that's the people. Let's talk about the issues, the substance, China, Ukraine, the economy, the former president. Kelly, what tops the agenda later this evening?
Well, they're not going to be able to avoid talking about the former president. He is the elephant that is going to be very much not in the room this evening. And even the Fox host of this debate, the moderators, have indicated that they will be playing sound of the former president in their questioning. So he is going to be unavoidable. But polling has showed just as recently as within the last week that what voters really want to hear about is substantive policy. The economy obviously will feature probably incredibly highly, as many of these candidates have said that Biden administration policies have contributed to inflation. Voters likely will want to hear what their plans to fight inflation realistically will be. And then on some of those foreign policy issues, everyone seems to be trying to out-hawk each other on China. Doug Burgum, who may or may not be in attendance just last week when he was speaking with us here at Bloomberg, was talking about the Cold War we are in with China and how it must be won. So that messaging will be key. Potentially talk of sanctions as well from some of these candidates. And then the issue of Ukraine. There is a bit of a divide within the Republican Party about what U.S. support should look like going forward. Of course, Ron DeSantis, who is likely, as Anne-Marie said, to be the target of many attacks tonight, previously called it a territorial dispute, then had to walk that back. Mr. Ramaswamy, who is looking like he is potentially in third place, could gain some momentum here, also has indicated that the U.S. should pull back support for Ukraine. So those are going to be some things to focus on. And, of course, we've heard from a number of these candidates about the fate of Fed Chair Jerome Powell as well. Mike Pence suggesting he wouldn't reappoint them. Chris Christie, though, told Bloomberg he maybe would. So market watchers likely will be watching that closely, especially ahead of Jackson Hole, John.
MH, as you know, winning a primary is very different to winning at the national level. Where does Ukraine feature in that effort?
Well, Ukraine is at an interesting point right now when you look at the Republican Party. As Kayleigh noted, you have some serious divisions, but also it's a difficult line for some of these candidates to walk. One, when we saw Ron DeSantis make that kind of fateful issue, saying that Ukraine is just a territorial dispute. He then had to walk it back, but also that really spooked some donors. The other issue why Ukraine is so important right now is because Biden is asking for more aid, and this is becoming a huge issue on the budget fight on Capitol Hill. And potentially, Jonathan, we might see a showdown when it comes to a government shutdown by the end of September, and Ukraine is playing very large when it comes to that. The far right of the Republican Party in Congress do not want to give more aid to Ukraine. So what the candidates say this evening could potentially give those members in Congress more of a nudge to continue fighting to not send more aid.
Anne-Marie, thank you. AMH alongside Kelly Lyons to the both of you. That debate later on this evening. Right now, I hate saying this, but this is how it's playing out. Bad news is good news for this market. Equities up, bonds bid, yields lower. Coming up, your trading diary. The headline today, disappointing economic data on both sides of the Atlantic, a rally in the bond market, a rally in equities as well. That's the price action. Here's the trading diary. New home sales coming at the top of the hour. Nvidia earnings after the closing bell. And the first GOP presidential debate kicking off later on this evening, 9 p.m. Eastern time. Another round of jobless claims and durable goods coming on Thursday. And finally, I'll see you over in Jackson Hole. Kicking off tomorrow with Fed Chair Jay Powell speaking Friday at 10:05 Eastern time. From New York, this was the countdown to the Open. This is Bloomberg.